Good afternoon and welcome to this week's edition of Halftime Talk. I'm delighted, as always, for our twice-a-year conversation with Dr. Anas Alhajji, Managing Partner of Energy Outlook Advisors. Great to have your voice at the table as we come towards the end of 2022.
Thank you very much.
Dr. Anas, we have to think a little bit about where we are at the end of this year, a turbulent year. Obviously, some major trends through it: soaring inflation, a war in Ukraine, OPEC plus trying to navigate its way through all of the turmoil and keep a relatively positive oil price in order for their fiscal balance sheets to be healthy enough. As we come to the end of the year, what sticks out in your mind as sort of the lasting sticky from the trends we've seen this year? What's gonna sustain?
Couple of points. One clear point is that we have a group of people in the market who are always ultra bullish and who think prices will go to $150, $200, $250. They predicted this in 2018. It did not work. They predicted this in 2019. It did not work. Of course, 2020 is an exception because of Corona. And then they predicted this in 2021. It did not work. They predicted this year. The only reason why we ended up with $100 plus oil is the Russian invasion of Ukraine. Without that, fundamentals do not support $100. And we've seen this in recent months. But before we discuss those in details, let's go back to 2021. There were two major events in 2021. So if a researcher looks at 2021, 50 years from now, there are two major events that distinguishes 2021 from everything else. And the first one is the change in OPEC/OPEC plus behavior, something we never seen before, which supported prices, as you know, from $40 to 75 plus. What happened here with the change in OPEC behavior is this, that historically, one of the failures of OPEC for a long time is that when demand increases, oil prices increase, those with spare capacity will overrun the others. They will overproduce their quota and take market share from others. When markets collapse, they start asking others to cut, and the others will say, no, because you cheated me. When oil prices were going up, you increased your production, you benefited at my expense, I did not benefit. In 2021, this stopped. The first time in history, we've seen major oil producers with spare capacity sticking to their quota and not infringing on the market share of others. This gives more credibility to OPEC and OPEC plus than ever. And that's why there is more trust in OPEC plus now than before, simply because of this policy.
But I would just take the opportunity to challenge that thesis that one of the reasons why we have such volatility in the markets this year, and there are many reasons, but one is because of that 21 trust, as you call it, that predictability and confidence that the market took from OPEC plus. In 22, that seemed to get to sort of dilute, collapse, whatever word you want to use, because the gap between actual production and production quotas that OPEC plus had identified as their target grew out to 3 million plus barrels. All credibility was lost.
No, not really. I'll tell you why. There is not a single model that model oil prices or the oil market in general that will count the difference between the actual quota and the actual production. All of us knew from day one, from April 2020, that some countries are not going to deliver, and the tweets are there, the articles are there, the interviews are there. So we knew this ahead of time, that some countries are not going to be able to do that. We knew when they created this compensation mechanism that those countries would grow out of it, in a sense, so they will meet their quota by just waiting it out until they cannot produce anymore, and therefore the compensation will happen automatically. So this is not really the source of volatility. The source of volatility in the market came in from several parts of the world, mainly the use of the SPR by the Biden administration, the war in Ukraine, and the sanctions and all the issues that resulted from it. Are we going to block Russian oil? No, we are not going to block it. Are we going to put a price ceiling, or we are not going to put a price ceiling? Add to that the lockdowns in China that added to the volatility. So the
it may not be the source of it, but they're all contributing elements to. I mean, OPEC went from a adding supply posture in the first half of the year to end the year with a dramatic cut of 2 million barrels on quota, however many physical barrels that ends up being. That kind of swings and roundabouts is a volatility exercise, because what it also tells you is that the OPEC plus countries, at least most of them, are not investing in their capacity production, that is eroded.
Let me explain it in various ways. So let me go finish that 2021 issue first.
Yeah, please.
So the first one was the change in OPEC behavior. The second one is what we've seen from China, which is the widely used or the policy of using the strategic petroleum reserves in a massive way to prevent oil prices from going to $100. So those were the two major changes. Now we come to 2022.
And when you say strategic petroleum reserve, are you specifically identifying the US, or are you saying China, across the whole IEA, or China as well?
China. I'm talking about, we've seen China basically releasing massive amount of oil in 2022, which prevented oil prices from crossing $100 in 2021. In 2022, we have three major events that characterize the year. We have the Russian invasion of Ukraine and the sanctions and the aftermath of that. And then we have the Biden SPR, that's the US Strategic Petroleum Reserve, which was the largest withdrawal in history. And then we have the third point, which is very important. We've seen OPEC or OPEC Plus move from the policy they adopted in 2021 to a more complex policy in 2022, where the only way you can explain it and understand what's going on in the market is this. You look at OPEC decision at the beginning of the month. And now, as you know, the meetings were monthly. So the meetings were always at the beginning of the month. Then you wait for the 5th of the month, where Aramco releases its OSP prices, because the OSP tells you whether the Saudis are happy with the decision or not, whether they are going to literally nullify the decision or support it. So the OSP basically will play a major role. And then we have to wait further to understand this further and look at the end of the month, what happened to supply. And the idea here is OPEC quota are based on production, but what matters to the market is the supply. So they could produce more, but if they are lacking that in storage, then the supply is lower. This will bring me back to your question about the cut, the 2 million cut. The 2 million
announced
cut,
in early October.
Yes. So the 2 million cut, basically, as you know, is from the quota, from the ceiling. The actual cut, if all countries abide by the quota, is between 800,000 barrels a day to 1.1 million barrels a day. But here is the problem. We go back to the third point I just mentioned. Production is one thing, supply is another. As you know, and you live in the Gulf region, so you know this, that oil consumption starts increasing in April because of the cooling demand. And it peaks in August and September, and then it goes back down. So that's because the cooling demand is met by power generation, and mostly they use fuel oil for that power generation. So we have domestic consumption. In the beginning, our estimates in the Gulf and Iraq were about 720,000 barrels a day, which means that by mid-September or end of September, they have 720,000 barrels a day extra. They don't know what to do with it because they are not consuming it inside the country. Now they have a choice either to cut production or dump it on the market. But if you go back to September, prices basically were in the high 80s for Brent. And if you look at the forward curve, it was in the 70s. So why dump 720 on the market at lower prices? So cut production. So what the idea here is, cut in production is one thing, cut in supplies in another. But the other related idea here is, we found out 2 days ago that the domestic consumption was way higher than 720. And probably it was close to 900. And that's only from the Gulf. You add West Africa, you add North Africa, etc., and you can see that the impact on supplies for that cut is very limited. But
it certainly hasn't. I mean, from the point of view of the immediate outlook, OPEC Plus made that announcement in early October for implementation from the 1st of November. We're now moving towards December, and the oil price on Brent has dropped below that critical sort of landing point of floor of $90 a barrel. How do you think that looks from an OPEC Plus perspective as we go into the last meeting of the year? Could we expect the group to try once again to keep that price above 90 with further cuts?
2 points here. First of all, I would like to clarify to the listeners that during the week on October 5th, when OPEC announced the cut on Wednesday, October 5th, that's where we got the impact of Hurricane Ian. And oil prices went up that week, mostly because of the hurricane, not because of the announcement. And if you look at the EIA announcement at the time of the meeting for inventories, we have a major decline in inventories that day. So we want to separate the impact of the hurricane from the impact of OPEC announcement, which was already very tiny, if any, from that day. So the increase in prices that week was related to the hurricane, not to OPEC. I believe, as you know, that OPEC ministers since 2016 are not or will not talk about prices because of the OPEC in Congress.
Yeah.
So they don't talk about prices, probably in private meetings or in the back of their heads, they do the calculations, but publicly they will never talk about prices. We've seen only one minister, which is the former Iraqi oil minister, talking about prices, and probably he got a phone call regarding that. But beside that, no one talks about prices. But you and I, can talk about prices. Generally speaking, it is very clear that they will defend 90. But we got to be very clear on this, that when we talk about defending 90 Brent, the Saudi pricing is based on the monthly average, not on daily prices. Because I do get those questions on Twitter and messages all the time. Oh my God, oil prices declined below 90 today. Do you think Saudis will act?
Yeah.
Well, their prices are based on the monthly average. They are not going to react to daily changes. And we've seen prices bounce back every time we went to 90 or below 90. We've seen Saudi storage going up, which means that they are willing to store oil, in a sense, to defend the prices. So I think they will defend 90. The problem is, if we end up, as you know, we have many people who believe that we are going to run into a global recession in 2023.
Yes.
If we end up with a major recession, OPEC Plus cannot defend 90. They have no choice. So
we're not there yet, though. And generally speaking, there's two things happening in a few weeks from now. One is OPEC Plus's meeting, and if we have a trend line of oil prices, I mean, the last time we dropped below 90, it required quite a vocal intervention by the energy minister of Saudi Arabia, and then not only vocal intervention, but actual action to reverse that trend line, that downward motion. Looking over the next few weeks, going into the OPEC Plus meeting in early December, at the same week in which the EU embargo on Russian oil is due to on shipped Russian oil is due to come into effect. How do they navigate those two things at the same time?
It's excuse me. And let's add one more factor because this is very important. And at the same time, the Biden administration will release 15 million barrels from the strategic petroleum reserves, which means that the possibility of another cut is very high. Here we have those issues. People think that this is the last of the 180 million barrels, and therefore this 700, 800,000 barrels a day of supply is going to stop, and therefore prices will go up. What they are missing from this point is this, that we still have the Congress-mandated releases that has not been released. So the Biden administration can still release oil from the SPR if they want to immediately after the beginning of the year, simply to fulfill the Congress-mandated requirements. They still have about close to 400 million barrels in the SPR, which means that they can release another 50, 60 easily without any problems. Even with the majority of the Republicans in the Congress, they can still release that without any opposition. We might hear some, sound bites here and there, but they can still do that. And China is already releasing oil from its SPR.
But it has to be noted that China did really build up during 2020 at the very big price discount that oil was available in the international markets. It massively ramped up its storage up to something like 1 billion barrels or so. That now over the last 21 and 22, it's started to draw that down. But why wouldn't you? Cheap barrels, draw them down during times of higher price.
Well, two things here. The first one is, as you know, at the beginning of the year, after the Russian invasion, they were getting the cheap Russian oil at the time of the lockdown. So they were able to rebuild their storage significantly because of cheap oil on one side and the lockdown on the other. The other point is, right now, as we speak, the total storage, the total oil inventories in China, that's strategic and commercial, is higher than that of the United States. And which means that they are going to use it. What we've seen in recent days, something very, very interesting, that we have diesel shortages in Europe and the United States, and Chinese refiners are coming to the rescue, and they are exporting more diesel than ever. And the joke is where that diesel is coming from.
From the refineries. From
the refineries that use Russian crude.
And other crudes. Obviously, Saudi Arabia is the biggest one of two biggest oil suppliers into China and others. But inevitably, there is Russian crude in there as well. Looking at the sort of those trend lines as we come to the end of the year, on the demand destruction side. We've talked a bit about supply side. On the demand side, the sort of concern of the war concern around supply disruption seems to be fading, even as we're going into winter. And now it's all about demand destruction and the outlook for that. China's not opening. Europe's gone into recession. The US seems to be in a very tight, significant tightening cycle on interest rates that could drive the economy into recession. Are we looking into the first end of the year a real demand destruction challenge?
I will go back to this point. I just want to cover a previous point that you mentioned about the sanctions on the 5th of December and the price cap. The bottom line is this, that Russian oil is going to reach Europe and the United States no matter what, in one way or the other. We already learned our lessons throughout the years from Iraq, from Iran, from Venezuela. They already worked on their system and the infrastructure to do that with the help of China, with the help of Iran. So the impact of the price cap and if it works, of course, I think the price cap is a joke. But for the sanctions, I think their impact is very limited, and I seriously think that some European countries will turn the blind eye to some violations and they will turn the blind eye to the exemptions that been given and the smuggling that's going to take place. They give exemptions to 5 countries, as you know, 3 via pipeline, and 2 because products, they needed certain products. What we are going to see is exactly what we've seen around the world. We are going to see trucks and cars basically crossing the borders, smuggling that oil to neighboring countries, although the EU banned such a thing, but it's going to take place. So on the supply side, like you said, the impact is very limited. As for the demand, the destruction or the decline in demand is going to be in terms of growth of demand, which means that the growth was, let's say, 3.5 million, and now it's lower. So it's not to the actual demand, it's to the growth, a reduction of the expected growth in demand. And this happens mostly, and people really need to pay attention to this because this is really causing a major problem worldwide, is the higher dollar.
Right.
And oil is priced in dollar, and the higher dollar, they call it the wrecking ball, basically. It's just causing major problems, wreaking havoc on the rest of the world because
it looks like it's peaked. Or is this just a sort of a bear market temporary moment in the, I mean, this is a question of whether, and that's was my next question in essence, is have we now come to a tipping point where we've got peak inflation and so peak rate hike and peak dollar? Or how do you see that now? The financial markets seem to have got very optimistic again that all those things have happened: peak rates, peak inflation, peak dollar. Your thoughts?
Couple of things here. First of all the data we are getting is mostly from the developed countries. All the data mostly are from the United States, and we are ignoring the rest of the world. We are ignoring Africa. We are ignoring Latin America. And those guys, I mean, if their stories are just heartbreaking. The inflation is still going through the roof. Look at the devaluation of the Turkish lira, for example, or the Egyptian pound. I mean, it's the pain is just unbelievable. Let's keep an eye on those countries that are not covered by the media, that the pain of this is still there and the situation is going to get worse. Let's remember that because of the war, the next crop season in Ukraine and Russia may not end up being there. And therefore, food prices and fertilizer prices and everything else will continue going up, despite the fact that oil prices are going down. So the issue of inflation in the rest of the world still exists, and it is a serious problem.
Yeah, the outlook for 2023 in terms of the second winter of this war, the second harvest. But as we deal with the more immediate outlook, the more immediate window, the China, there was a sense only a week or so ago that China might be lifting its COVID restrictions, or to a certain extent lifting its COVID restrictions, and with that a sense that oil demand out of China going into the end of the year, into the Chinese New Year, may be a sort of bullish factor for oil prices into the end of the year. That doesn't seem to be the case. All the factors are piling up on a weaker oil price outlook. Does OPEC Plus react?
Yes, China's problems are deeper than only the lockdowns. I mean, their economy is really in bad shape. The drought wreaked havoc on some parts of China and certain industries. The higher prices, of course, of LNG in particular, wreaked havoc on certain industries. The cost is very high. So even if they open up, we are going to see a weaker economy on one side. On the other side, they are going to use their SPR, as I mentioned. So the outlook, yes, it is weaker. And OPEC is expected to react to that because they always believe in a kind of a preemptive strike. But as you know, they have to balance, they learned the hard way. They have to balance the politics of the cut with the economics of the cut. We've seen them before go for the economics at the expense of politics, and they've seen the media reaction to that.
They seem to have been proven. I mean, they've got some I told you so opportunity at the moment, don't they? I mean, a month ago they took a lot of heat, and now we're seeing that demand destruction and oil price dropping into the 80s and perhaps further.
Yes, the problem is the Europe and the United States, they need prices in they would love to see prices in the 60s, not in the 80s and 90s. So for them, this is not satisfactory explanation that prices drop. They really wanted to see low oil prices. And here is the contradiction. You cannot go to COP27 and bash the oil industry while you are asking for a lower price, because lower price leads to higher emissions. And this is kind of the contradictory thing about the COP27.
Yeah, the COP27 has kind of come now and gone, and you'd have to say, while there's perhaps some significant outcomes, if indeed a number of other things there happen, but it has had little impact on the trajectory in the short term of the oil price cycle, and we're actually looking at where does the end of the year go. It sort of has discounted COP27. At this stage, it looks like the oil markets have more or less priced in all things Ukraine. Your thoughts at the end of the year for all things Ukraine and the war and its impact on the oil markets and commodities in general at this point, oil markets in particular. Let's stick with that. It seems we've kind of that is at least for this time being not a major issue.
If you go back and look at the explosion of Nord Stream 1 and 2 in the Baltic Sea, and you look at what happened, we should not discount events like this in some pipelines. I studied what I call the oil weapon for more than 25 years. And we should not discount those events. But at the same time, they are not the main scenario. But the issue here is, if Putin is cornered, expect other things to happen. That's really a real scenario that we have to look at. That's why, if you look at the price cap, the Europeans were extremely careful not to corner him. They will release the price cap based on what they said next Wednesday. We will see what the price is. People are talking about 60 to 65. There is a reason for 60 or 65, because the break even for Russian oil with taxes is 55. If they go below 55, they are giving incentive to companies to shut down. If they shut down, then prices will go through the roof, and they don't want that.
You think that the price cap, if and when it's delivered, is in any way policeable, manageable?
Not at all. I mean, that's why I say it's a joke. It's
a joke.
Yellen got obsessed by the idea, and they kept pushing for it. And every time someone pokes a hole in it, they bring in another solution with other problems.
It might be a joke, but like OPEC is a joke, but it keeps getting processed.
No. Sorry, and OPEC is a completely different issue, because OPEC. Okay, let me talk about the price cap for a second here.
Yeah.
With the price cap, imagine this: that the Germans are telling the Indians, okay, you cannot buy Russian oil unless you buy it at $60. Okay, how you said the word policing? How they are going to police that? And why the Indians will subject their ships, or the Chinese subject their ships to inspections, and they submit all the paperwork to prove themselves to the United States or to Germany? This is not going to happen. So the idea, EU is going to cut Russian imports. Therefore, the price cap is not for Europe. And the US already officially cut its imports from Russia. Therefore, the price cap is not from the US. So who is the price cap for? Imagine this, that despite the war, the trade war with China, the US is giving a gift to China, telling them, look, I want to make sure that your cost is very low. I'm going to give you oil for $60. And the Chinese will reply, I'm already getting it at $60. I've been getting it at $60. Why I have to submit to you?
I don't need your gift. Thank you very much. Anas, we could talk all day, and we'll have to find another opportunity to do so, because we've reached the end of our half hour of the halftime talk here at the end of November. It's an absolute pleasure, Dr. Anas Alhajji, the managing partner, Energy Outlook Advisors. We'd love to have you back on January the 11th for our annual outlook for the year ahead, where we bring voices from all around the world in 12 hours, starting early morning Asia, going right through the day to end with Anas in Texas. So hopefully you'll block your calendar for a bit of time on January the 11th, Anas. But until
count me in,
count you in, absolutely. Until then, have a great holiday season, and thank you for your time.
Thank you.